Hi, this is Liz Higgins, an Ag Business Extension Specialist with Cornell Cooperative Extension. And on today's 20-Minute Ag Manager, we're going to talk about budgeting and different types of budgets you can use when managing your farm business. So the three types of budgets that I'm going to go over today are enterprise budgets, which are used to evaluate a whole enterprise like blueberry production on your farm. Partial budgets, which are an efficient way to evaluate a set of specific options. Something like maybe if you're a blueberry farm, whether or not to use exclusion netting versus your current insecticide regime. And then finally, I want to touch on cash flow budgets, and those would be budgets to help you plan the inflow and outflow of cash over the growing season. So let's talk about first enterprise budgets. They are kind of the core budgeting that you should do whenever you're thinking about taking on a new type of business for your farming operation. The key thing that they do is they estimate the estimated expenses and estimated revenue to be received from a new enterprise. They can use this data to support an application for credit. So if you're going to go to get a loan, they will probably want to see some version of an enterprise budget to get a sense of whether or not the business is likely to generate enough revenue to pay back the loan. When you're putting together a new business as part of your business plan, an enterprise budget can help sort of provide a reality check on the inputs and production practices that are required. So it really can help you with planning. You can make sure that you haven't forgotten something major, some expense or something that's likely to throw all of your plan right out the window. It helps you estimate the benefits and costs of major changes in production practices. So once you've developed an enterprise budget and you've got a pretty good handle on the numbers and you really sort of have an overall sense of your costs and your revenue, then you could start to do scenarios. You can start to change up some numbers and say, okay, if I were to double production or I were to reduce labor costs by 25%, what's likely to happen? What's the likely impact to be on my farm? And finally, all of this information is the basis for a total farm plan. It's the series of different enterprise budgets for your different enterprises allows you to sort of take a big picture look at your farm and see how different units of the business can contribute to your overall wealth. So when you get started, it can be a little overwhelming. So here's a few tips for developing an enterprise budget. Generally, when you're doing an enterprise budget, you do it for some unit of measurement. It could be per acre or per square feet or per head for livestock. And this way allows you to allocate all different types of expenses and all different types of revenue, and you're converting it all to the same unit so that you can actually get a better measure of your input costs and your revenues. The enterprise budget should estimate your revenue for different types of products and byproducts for the enterprise so that you can really assess overall how it contributes to your overall bottom line. So it may mean breaking down revenue by grades or by different marketing outlets. So it could be restaurant sales versus farmers market sales, because you may have very different prices that you're selling under, and that combination of all of those prices will lead to your overall revenue. And then finally, you want to make sure, because a lot of times people don't do enterprise budgets or any type of financial records because the burden to collect data is too high. So if you have limited time, you want to spend more time getting accurate prices and data for items that have a high impact on total costs. Don't spend a lot of time chasing down something that's really a marginal impact on your overall business. You want to spend more time getting really more accurate things on those prices and volumes on those types of things that are very impactful. Labor would be a good example. You want to have a really good handle on your costs of labor. Maybe your cost to twist ties, not so much. So extension systems and land-grant universities are a really good resource for finding template enterprise budgets. You want to try and make sure when you find some budgets that they are for similar systems and scales of the type of operation that you're planning to have. So an enterprise budget for a garlic operation, wholesale garlic operation in California, is probably not going to be quite as relevant to a garlic operation on a diversified vegetable farm in the Hudson Valley. So, you do want to look at different enterprise budgets from different universities to see where there are significant cost differences, to see what their assumptions are for labor rates, input costs, fixed costs, and then take all of that information and think about how your system is going to be the same or different as your template enterprise budgets. Because all of these template ones are for, either some average farm or some theoretical farm. And your farm, the only accurate numbers are really going to be for your specific situation. You also want to do some legwork to see if your yield assumptions, prices, and market demands are realistic for your situation. Because I see sometimes people, they'll look at an enterprise budget and they'll say, oh, turkeys sell for this. Well, that depends. What is your market? What is your demand for that? That may be very different than this other region, this other type of system. So it's also very important to understand the difference between variable and fixed costs, because that will play in later on to how do you use some of this budget information when you are actually going out and trying to market your crop. Variable costs are those expenses that vary with the output within a production period. And so variable costs in a crop production system could be seeds or plant, fertilizer, fuel, machinery repairs, seasonal labor. And the one way to think about variable costs is if you don't produce, you won't incur the expense, right? So they vary with how much production you do. And if you produce more, your expenses, your variable costs will go up. If you produce less, your variable expenses will go down. So there is some type of a relationship between production and labor level of production and these costs. Fixed costs, on the other hand, are those costs that don't vary with the level of output, and they don't change in the short run. They include things like taxes, repairs on your fixed assets, insurance. So in the short run, for a fixed cost, you will incur the same expense whether or not you produce or sell anything, unless you go out of business, of course. But you do also have to remember that there's a temporal aspect to this. In the long run, all costs are variable, right? So in the long run, as production goes up, you may have to buy more land. So land costs will become a variable cost at that point. So the difference is in the short run, costs that you incur regardless of production are fixed costs, and in the short run, costs that go up and down based on the level of production would be your variable costs. So how do you use this enterprise budget information? One key thing to understand is that in order to be financially viable, an enterprise has to be able to earn a profit above its total cost in the long run. And your total costs, I just want you to remember, are your variable costs and your fixed costs. So it's important to have a handle on those. But one question is, when the revenue that you're going to receive will be less than total costs, should an enterprise be discontinued or should it be continued? How do you know when to pull the plug on an operation? So the answer may be to continue the enterprise, so to make the sale if the returns that you're going to get, the revenue you're going to get, is above the level of your variable costs, and this is very critical, that this is a short-term condition. So it's economical to continue production in the short run if your income is higher than your variable costs of production, but below your fixed costs of production, because any dollar above your variable costs will help you pay for your fixed costs. Whereas if you don't generate any income, then you have to pay the full amount of your fixed costs. If your price, however, is below your variable costs, you're just flat out losing money, and you should stop. But in the long run, it's really important to understand that if your variable cost, if your revenue is not covering both your variable costs of production and your overhead and your fixed costs, then you're not in the long run going to have a very successful business. You will be gradually running that business into the ground. Because if you can't cover your total costs, you won't be able to replace your machinery when it wears out. You won't be able to upgrade your equipment. You won't be able to build any wealth or equity in the business. You'll be covering your immediate costs, but you won't be building any wealth. And eventually you will use up your assets because you won't be able to generate enough money to replace them. So one key way to do this is to make sure that you are able to receive and understand the prices that you need to receive in order to generate the revenue that you need. So one way to look at this is break-even analysis. A break-even price is your total costs divided by your expected yield. And this would be the minimum price per unit that you would require in order to cover all of your projected costs at the yield that you expect to have. And this gives you a target. So if somebody offers you a certain amount of money, you'll know, yeah, I should definitely do this, or no, I shouldn't. Or as you're doing your planning, if you take your projected costs when you've developed your enterprise budget and you divide it by your expected yield and you see your break-even price, and then you go out to markets and you realize that your break-even price is $2 above like the current prices, then that might not be a viable operation for you. Either you have to increase your yields reduce your costs in order to actually be able to be viable. And the other way to look at this also for break-even analysis is, let's assume that prices are relatively stable and fixed in the market that you're going to be operating within. Then you want to know what your break-even yield is, right? Because yield at that point is what you will need to be able to manage. So you would divide your projected total cost divided by your expected price and figure out how much do you need to produce in order to cover all of your costs. And the difference between a break-even analysis with calculating break-even yield versus a break-even analysis with break-even price is, in some markets you have some level of price control. So you want to figure out what price do you need to set given the yield and the price and the costs. And in other markets, you're a price taker. You're not going to be able to change the price. So the only thing that you can control is yield, and you need to know what yield you need to set in order to be able to be profitable. And in both cases, you'd also be looking at costs. What do you need to do to costs to get yourself to that place? And ultimately, as you're doing these types of break-even analyses, you can get a sense of what combination of prices and yields are both feasible and also, and in that feasible range, is it likely to generate enough profit for you? So you can play with different levels of yields and different levels of prices, and like I did in this chart here. And that grid will give you a determination of like, okay, so what zone do I need to be in? And is that zone really realistic given my soils, given my labor, given my assets, and given the markets that I operate within, for me to make the decision to pull the trigger on this operation? So we've talked a lot about enterprise budgets. Now I want to touch on partial budgets. Partial budgets are a slightly more efficient and targeted type of budgeting when you're really looking at making a decision among different options. So it might be whether or not to adopt a new production technology, make a capital improvement, modifying a production practice. Rather than going through a whole bunch of different enterprise budgets, you might use what's known as partial budgeting that is much more targeted to looking at the costs and benefits of the specific enterprise. So in a partial budgeting, you're only looking at differences between the status quo and then the other options you're considering. You're only going to look at like new or additional costs that'll be incurred, how much income will be lost or reduced, and everything is specifically due to the change. And the goal of partial budgets is to be able to make these decisions among different options both accurately, because you capture really important data and make decisions around that, but also efficiently, so that you're not including information that isn't relevant and that isn't really impactful as far as making that decision. There are 7 steps to partial budgeting. The first one, number 1, is really critical. You have to be able to clearly delineate what the change is and what your assumptions are around that change, and exactly what the alternatives are that are being considered. The next step would be to list the additional costs from the alternative. The next one after that would be to list all the likely reduced income from the alternative compared to the status quo. Then you would list the additional income compared to the status quo, and then list the reduced costs compared to the status quo. And you will use this information to calculate the likely change in profit. And you may find that in some situations that change in profit is not enough to make it worth a disruption, even if it is shown to be marginally profitable. In other cases, you may find that a small profit is totally worth a disruption. And the reason why it may be worth a disruption are these intangible aspects, which is step 7. You want to consider other factors in evaluating an alternative that can be positive or negative and maybe more important than economic considerations. It could be change in the amount of leisure time, it could be health considerations, it could be stress considerations, it could be ease of management, it could be building goodwill in the community. It could be like those sort of social investments that you think will pay off later on. So they're hard to quantify, but you feel like those intangibles that may make something that seems more attractive, more economically attractive, either less attractive, or something that's economically less attractive, still more attractive because of the intangibles. So in this example on this slide, I've done a comparison of using exclusion netting versus insecticides to manage spotted winged Drosophila in a berry farm. And these are totally made up numbers. So this is not actually a budget. But let's just say, I've got increased infrastructure and labor costs from the netting. So I have $13,000 in increased costs. I have assumed there's no change in yield, so I'm not planning to see a reduction in income if I change from insecticides to exclusion netting. But I am assuming an increase in income because I've got some customers who want reduced spray berries. And I'm also assuming an $11,000 savings from the reduced sprays, from the labor and the chemicals that I don't have to buy. And so my overall change in profit for this case is $3,000 positively. So it's favoring exclusion netting. But then there's the intangibles, right? So it may be that there's some positives. I have got customer goodwill, perhaps, concern about the environment, working conditions. My workers don't like putting on all of the protective gear. In the summer, it's really hot. But I also may be concerned. Another intangible may be concerned that I'm worried about more maintenance and I don't have maybe the labor for that, or I'm worried that it may still fail, that people will leave the screens open, that I may end up having to use the insecticides anyway because the exclusion netting is not sufficient. I've never used it before. So, I may end up deciding that $3,000, I'm really not sure that I'm actually going to generate that. But these are the steps I would go through in thinking about these two options using a partial budgeting technique. And last but not least, I want to talk about cash flow budgeting. And that's to really help you plan for the inflow and outflow of cash so that bills can be paid throughout the growing season. Because what happens with a lot of small businesses is if they don't have good cash flow management, they run out of cash and maybe can't access credit, affordably or in a timely fashion. And then suddenly they can't pay their bills. And after several months of not being able to pay bills, their workers quit or they lose their lease. So cash flow budgeting throughout the growing season is really important. I've got an example here of an enterprise that's got a $26,000 profit at the end of the year. But if you look at during the year, there are long periods of time where they don't have enough income coming in to cover their expenses, and they are showing a deficit. By June or July, they've got a deficit of $56,000. And so knowing this, the farm would either need to start the year off with more cash, or they would definitely need to plan to take out short-term operating loans and make sure that they can do that. So if the farm started the year out with $56,000 of cash on hand, they would not run out of cash during the year under this budget. So for example, so if, in December, let's just say a farm had $82,000 in the bank, they would need to make sure that they held on to $56,000 as of that January, and then that would get them through the year going forward. And that other $26,000 of profit they could do whatever with, but they would want to make sure that they had access to that $56,000 of cash on hand. And that would then ensure that they had adequate cash reserves to get them through the entire planning season without having to worry about not being able to pay debt or wages or anything as the year went on. So that's what I have on budgeting. I've got 2 more videos coming up for the summer 2019 series. The next one will be on understanding the Schedule F. It'll talk about filing your taxes as a farm business. And then finally, the last one for the summer series is going to be talking about sales and property tax issues for ag. And this is definitely going to have a New York State focus. So if you are not from New York, then you are SOL and you need to find out about your own state. So with that, I guess I'm done.